Okay, we are back. I'm very happy to have on the Goldstein on Gelt Show Professor Donald Boudreaux, who is a senior fellow with the F.A. Hayek Program for Advanced Study at George Mason University, where he is a professor of economics, and he's sometimes called a kind of libertarian professor. Now, Don, I want to ask you the question because a lot of people ask me what's going on in the economy, and I like to tell them that the government is trying very hard to make it better. Do you think that the government is actually able to make the economy better?
Depends what the government does. In most of what the government actually does do in its attempts to make the economy better, I believe make the economy worse. The government's this huge actor. In most countries, it has a monopoly over the money supply, and when it acts, it, in my view, injects far more uncertainty into markets than would otherwise exist. I believe that's why the current Great Recession has lasted as long as it did. I'm convinced that's why the Great Depression in the 1930s lasted as long as it did. One of the benefits of free markets is that you decentralize decision making. You don't have one big player like the government meddling in matters. With decentralized decision making, you get some people's mistakes being offset by other people's better decision making, better choices. With the government, because it's so large, it can push everyone in one direction. And unless that one direction happens to be the correct one, everyone has to go along in that direction. In most cases, that direction, I think, is a bad one. There's no reason to think that government officials have particularly good knowledge about what the future holds and about how markets act. And so I prefer to leave decision making up to individuals. I don't like demand stimulus. I don't like discretionary monetary policy. I think those things make things worse over the long run.
Okay, let's go back over a couple of definitions, because one of the terms he used, which a lot of people hear, is the Great Recession, that seemed to have started several years ago. In fact, it was around the time when President Obama came into office. And
Right.
yet people say, but wait a second, during that time, when he took office right after Bush, things were really crummy, and well, quite frankly, the stock market has recovered to all-time highs. And if you look, in fact, a recent article by I'm sure your very good friend Paul Krugman pointed out that there's been a large cumulative growth in private employment. So they're saying, what recession? Things are actually looking better now, although now it's a little bit frightening.
Well, again, the recession started 8 years ago or 9 years ago now. That's a long time. And it's just now, the economy in the U.S. is just now getting back to normal. And even there, the labor force participation rate in the U.S. is disturbingly low. I believe one reason for this is that is because of government intervention. It's true, the stock market has recovered. One of the great things about the market, in my view, is how resilient it is. Government has to be really, really bad in order to destroy the market over the long run. But that doesn't mean that when the government acts in the short run and the problems that it causes in the short run aren't themselves significant. So I believe that the uncertainty that is unleashed by active government demand management policies and government discretionary control over the money supply cause more harm than good. Put differently, had the U.S. government not behaved as it did in 2008, 2009, I believe that the Great Recession would have been much shorter, and the condition of the economy today, including the condition of the stock market, would be better.
Well, I guess we can't really test that. Let me go back to the word you used, which was resilient.
That's true. That's true. That's true.
The term you used was resilient, that the market is resilient. And to me, my day job is that I'm a financial advisor. I only get to do this radio gig a couple of times a week where I speak to interesting people, but most of the time I'm talking to normal people about investing for the future and their retirement and that kind of thing. And, we always tell them, well, be a long-term investor. So what you're
Right.
saying to me actually sounds pretty good, because you're saying that maybe no matter who wins the next election or the one after that, overall the economy is going to keep growing, and don't worry about the 4-year stints of who's ever in the White House, but count on the fact that it'll be resilient. Do you think that's actually true for a long-term investor?
I actually am a long-term optimist. Um, I think the economy would be better, both in the short run and long run, if government were more restrained in its activities. But because the market is so resilient, and because it is now. The globalization genie is out of the bottle. I think this is a good thing. So now you have literally billions of people participating in one global economy, and that's a wonderful thing for humanity. This globalization reduces the ability of any government, including one as enormous as the United States government, to muck things up as much as they otherwise would. So yeah, I am a long-term optimist. What happens next year? What happens 4 years from now? Maybe up, maybe down. But I have an 18-year-old son, and I'm pretty convinced that when my 18-year-old son is my age, I'm in my mid-50s, the world he lives in will be more prosperous, much more prosperous, even than is the world we live in today.
We are speaking with long-term optimist Don Boudreaux, who's a professor of economics at George Mason University. He also writes extensively about Hayek at his blog called Café Hayek, and he, in fact, has a newest book called The Essence of Hayek. So starting with that as the viewpoint, from where his economics come from, we've been talking a little bit about government intervention in the economy or government involvement. Don, I want to focus on probably one of the concerns that people talk about the most, which is the U.S. debt, which is pushing $20 trillion. And some people say that's just a fraction of it because of the unfunded future debt for things like Social Security. Should we be afraid?
I tell you, if one thing scares me, if you would ask me, name one thing that scares me most, it is government debt, whether it's formal or informal, because the government feels an obligation, mostly for political reasons, to honor these debts, and the resources used to pay those debts have to come from somewhere. Those debts are enormous now in the United States, and so as those debts come due, the government is going to have to take more and more resources from the private productive sector in order to pay off those debts. In the past, people have worried about government debt, people who I respect, and the fears have always proven to be overblown. I hope that's the case for the current fears about government debt, but it is the one topic, the one thing that is looming today in the economic sphere that has me most frightened.
Well, let's dive into this a little more, because the Fed just raised rates a little bit, and the fears that they're going to, or the plan, I guess, is that they're going to raise rates a little more. How will the U.S. government, be able to continue to fund this debt if it goes up, not just a quarter point, but eventually a half and 3/4 and 1 or 2-3%?
Well, there are various scenarios, and I certainly don't know which one will play out. I mean, one scenario, the optimistic scenario from my standpoint, is that government realizes that it really needs, in order to pay off these debts, to service the debts, it really needs strong economic growth. And then so perhaps some sensible people will be in charge, and they will dramatically lower tax rates. They'll deregulate the economy in ways that I think would be productive, and economic growth will bloom, and that will enable the government to pay off these debts without too much problem. The pessimistic scenario is that in order to pay off the debts, governments do the opposite. They double down on regulating the economy. They increase tax rates. That will only make things worse, because it will diminish economic growth, and the actual amount of revenue the government will get from its increasing taxes on the people will fall. So how it plays out is an open question. It's a political question. History will tell us. But I do fear that the pessimistic scenario is certainly possible. In the past, the optimistic scenario has oftentimes played out. I'm old enough to remember the 1970s, and that was the era of malaise, and I'm not sure why it happened, but there was deregulation, tax rates were lowered, and the economy boomed, and that diminished the burden of government's then debt obligations much more than those burdens would have diminished had the tax rates been kept high and the economy not deregulated to the extent that it was.
So is there a direct proportion that is actually repeatable? In other words, you've seen over, we can even say in your lifetime, because I'm willing to say that before then things might have really been different, but is there a direct correlation between a decreased tax rate, and I assume you're talking about personal income tax or corporate tax, and the growth of the economy?
Income gains, yeah. Yeah, I'm talking about in the 80s, the capital gains tax was reduced, personal income taxes were reduced.
So let me bring up your friend again. Why does Paul Krugman disagree with you on that?
Wow, I don't know Paul Krugman.
I'm just kidding. I'm saying the general the general person who doesn't agree in lower taxes.
Because Paul Krugman is a Keynesian. He's a proud Keynesian. Keynesians focus not on the supply side. Keynesians focus on the demand side. All they see is demand. And so if there's a problem in the economy, it must be because there's insufficient demand. And I see incentives operating on the individual. And so when taxes rise, I don't care how much government and how quickly government spends the revenue from those increased tax rates. When tax rates rise, that discourages productive activity on the part of entrepreneurs. It discourages work effort. That discourages investors from taking risks that they otherwise would have taken. And it's those reductions in supply, it's that reduction in productive activity and creative activity that damage the economy. There's no amount of increased demand that can make up, in my view, for the reduced productivity that comes about as a result of higher tax rates.
Okay, I guess I as a business owner as well, I'm certainly sympathetic to that view, because I do really feel when the government raises taxes, it's a discouragement to me and to to hiring, and when there's more regulation, it certainly slows it down. But I guess time will tell, and it is interesting to get the perspective that you're bringing up, which is that there is a solution to the debt problem that the U.S. has, and we don't have to necessarily feel the whole thing's got to collapse in order for it to work out well. Is that a good optimistic way to close?
That is a good optimistic way to close. I do remain optimistic, and I think the thing can be resolved. But let me say, calling myself an optimist does not mean that I'm a Pollyanna. Being optimistic does not mean that I'm in any way certain that things will work out. Sensible people and sensible policies have to be in play in order to avoid catastrophe.
All right, so we will hope for sensible people and sensible policies, especially in this upcoming election. Don, listen, I want to thank you very much for taking the time. In the last few seconds, just tell me, how can people follow you and follow your work?
Well, I blog at Cafe Hayek, www.cafehayek.com. That's pretty much it. I put almost everything I write up at the blog, and I blog 2 or 3 times a day, along with sometimes with my former colleague, Russ Roberts.
Okay, and we will put a link to that at the show notes of today's show, as well as links to some of your books. Don Boudreaux, thanks so much for your time.
Thank you.
You've been listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Doug's weekly radio show is heard around the world, but if you miss it, you can download the podcast at www.goldsteinongelt.com. The Goldstein on Gelt Show gives you up-to-date financial ideas so you can get on the path to financial freedom. If you'd like your questions answered on the air or off, send Doug an email to doug@profile-financial.com. It's your money for your future, so join Doug every week to build your wealth on the Goldstein on Gelt Show.